Let's take a look at Restaurant Brands International, and this company owns Burger King, Tim Hortons, and Popeyes. So we want to calculate the intrinsic stock price using prior financial information. So let's see what the market cap is, 16.227 billion. And the stock price is 55.15. Now next we need the free cash flow. And that's the best way to calculate the stock price, is to estimate the free cash flow for a company and then discount those numbers back to today's values. And then next we need net income. So net income is used in the model, but we don't forecast net income to figure out the value of a company, because on the income statement you'll see a lot of non-cash items, and the income statement also uses accrual accounting. So this makes it really difficult for valuation purposes. And last financial piece is revenue. And that's just the sales by year. So now that we have the cash flows estimated, let's look at that capital structure. And we need to figure out the discount rate to use. So first we're going to look at their debt. So they paid $523 million in interest. And then their current debt is $101 million. That's debt due within 12 months. And then their long-term debt, that's debt due beyond 12 months. So they pay 4.41% on their debt. And interest payments are tax deductible, so we need to discount it by the effective tax rate. So we got to go back to the income statement, and let's see the EBIT, the income before tax. And now the tax expense. So their effective tax rate is 23%. So the cost of debt is 3.37%. And we also need to find out the cost of equity. So to do that, we need the beta, which is 1.37. That's the volatility of the stock. And the cost of equity, according to the capital asset pricing model, is 12.84%. And equity is always more expensive than debt because it has a lower priority on the capital structure, and therefore it's more risky. So the weighted average cost of capital is 8.84%. So that's the cost for this company to obtain financing. So if they were not generating at least 8.84% in their normal operations, they would not be providing value to the stockholders. So they need to at least produce 8.84%. And if they don't for a long period of time, they could go bankrupt. So now that we have the discount rate, we know what to discount the cash flows by, and the current value of the company is $19.5 billion. And if you divide that by 294 million shares, we calculate the stock price at $66.27, which is a little more than they're currently trading at. They're trading at 55.15. So we can look at the historical stock price, and it was trading around intrinsic value a few months ago and a little higher than intrinsic value. So why doesn't our calculation line up with the actual price? It just pretty much boils down to the market doesn't project this company to be worth $66. The market is saying they're worth $55.15, at least today. Maybe in a few months, or maybe even tomorrow, it goes up, it goes down, but that's all the forces of supply and demand of the market. So what do you think this company is worth? And let me know if you want me to run a cash flow model on a different company. Thanks for watching.